All right, hello everyone. This is Derek Jensen. We're going to be starting our Understanding the Washington State Estate Tax presentation. So welcome everyone for joining us. Thank you for joining us. In today's presentation, I'm really going to review and go over a number of details about the Washington estate tax. We're going to look a little bit at legislative history. Where did we get this thing? How does it differ from the federal tax? A few examples of how the tax comes to impact people. And we'll also look at a few strategies for dealing with it. So I hope you enjoy it. We will have questions and answers at the end. So please go ahead and get your questions in, and we will look at those when the time comes. All right. So first of all, why is the Washington State Estate Tax important to you? Really, the issue here is that the Washington State exemption is $2.193 million, and that just isn't as much as it used to be. And so more people in Washington State, especially here in Western Washington, are finding that their assets are greater than this number. They include really, when we talk about estate value, which assets are going to be included in the estate for this purpose, it is practically everything. So it's the equity you have in your home. If you have any retirement accounts, it's the value in those. Your investments, your bank accounts, your business interests, and also life insurance, including group term life insurance that you may have through your employer. You take all of that into account, and it's not that hard anymore to get above $2.193 million number. We've seen significant inflation over the last few years, both in real estate and in equities. And as those assets have gone up in value, that has made this more of a relevant tax for people. Now, you may ask, why the heck do we have a number of 2.193 million? Where did that ever come from? And this is an interesting point. So we will look later at the full history of the Washington State estate tax legislation. But in 2014, the legislature passed a law starting indexing for the Washington exemption. So at that point, our exemption was $2 million even. And the indexing continued to work until 2018. So we only had 4 years of indexing. And it went from $2 million to $2.193 million and basically stopped right there. But if it had continued, we would estimate that the current exemption would be something like $2.772 million, $2.73 million. So about $580,000 more of exemption. This just illustrates how much that lack of indexing has impacted people. Just imagine for yourselves, if you go back to 2018, what was your estate worth then, and what is it worth now? And that is really shows the magnitude of this problem and how it's growing and becoming a bigger issue for more and more people. So how does this tax work? Well, it is a graduated tax starting at the amount above the exemption, and then it continues on with rate increases approximately every $1 million. The rates are between 10 and 20%. The first million is at 10%. The next million is at 14, then 15 and 16, and it continues on up. So just to show how that would work, if we had a $3 million estate, there would be approximately $807,000 of taxable estate, and the tax on that would be just at the 10% bracket. So it'd be about an $80,000 tax. As that estate continues to grow, the next tax bracket would be 14% and then 15% as it goes up in value. How does this relate to the federal tax, and what are the differences between the Washington state estate tax system and the federal estate tax system? So first of all, let's look at the thresholds. The Washington state exemption, we looked at that already. It's 2.193 million. The federal threshold this year is 13,610,000. In 2025, we're expecting that will increase to just under 14 million at 13.99 million. However, 2025 is also a sunset year for the federal, and which would cause us to go back then in 2026 to the previous law, which would basically cut that exemption in half. So we could be back to $7 million at the federal level, thereabouts, in 2026. The tax rates, I've already mentioned these. So again, the Washington state estate tax rates are graduated between 10 and 20%, and they apply to anything above $2.193 million. The federal tax rate, on the other hand, is a flat 40%, and that applies to anything over that $13.61 million. I will note that you may use part of your federal exemption not only for the federal tax, but also for the state or for the federal gift tax. So for example, if you make a gift, it may be greater than what is available for your annual exclusions, and we'll talk about that a little bit later. That would dip into that $13.61 million. So for example, if you made a gift of $500,000, you would be using a portion of that federal exemption, and then at death, you just wouldn't have as much to cover, or already much available. The legislative background, again, on the Washington state estate tax, we spoke already about the indexing, but how did this come into play? Washington used to be what is known as a pickup state, so it would pick up a portion of the federal estate tax. In 2001, under President Bush's tax bill that year, we started to see a phase out of that tax credit. And when that started to happen, then the state of Washington was no longer able collecting taxes. There was a Washington state court case that showed that the old law was not going to continue on. The state of Washington would not be eligible to collect taxes on their own without that tax credit from the state. And in 2005, the Washington state legislature enacted our own estate tax. The Washington estate tax essentially borrowed from the federal tax law in place at that time, and then since then has become uncoupled from federal law. And so we have developed our law separate and independent of the federal law since then. And then the other major thing that happened was in 2018, the Washington state indexing stopped. But we haven't seen any efforts yet to fix that indexing, and we haven't seen a lot of discussion about eliminating the Washington estate tax or bringing it back in line with the federal tax exemption. So something to keep in mind. We haven't seen a lot of action on that. So what kind of ways can we reduce the Washington state estate tax? We talked already a little bit about gifting. Gifting is really a key idea when we think about the Washington estate tax. The issue here is that any amount that you gift during your life will be excluded from your estate, and therefore will not have to pay estate tax on it. So what kind of gifting can you do? What are the gift rules? Gifting, there isn't a Washington state gift tax law. So really, when we're talking about gifting, we're thinking about the tax laws for the federal government. So for the federal government, you can have currently annual exclusion gifts of up to $18,000 per year per recipient per donor. So a married couple could give to one of their children and their child's spouse. Really it's 4 times that 18,000. So what would that be? That would be, I guess, $72,000 in a year without using within the annual exclusion. We estimate that the annual exclusion will index for inflation for next year and will be approximately 19,000 next year. We also have the lifetime exemption. So I spoke about this a little bit. It's the same number as used for the federal exemption. They are unified in the sense that if you use a part of your lifetime exemption, that will reduce your federal exemption that's available to you. But there are other types of gifts that you can do. You can make gifts directly to pay for tuition or directly to pay medical expenses. If you do that to the institution, that would also be a lifetime or an annual gift, or a gift that's excluded from federal estate tax system or gift tax system. There you go. Additionally, I just discussed, decreasing the size of the estate for that purpose. But we also are getting that immediate benefit of increase, providing something to your loved ones. And for some folks, using the lifetime gifting now would be better than having to wait until and possibly losing that in 2026. So why do people not gift? So this is looks like a great strategy for getting rid of the Washington estate tax. Just make those gifts prior to your death. A number of reasons that my clients have told me. It might be, for example, that they are still developing what they're going to need for their own retirement and their own uses. And so they don't feel comfortable gifting yet. It may be that the beneficiaries aren't ready. Maybe they're too young. Maybe they're in their early 20s and aren't quite ready to receive those kind of assets. Oftentimes it is tax related, though. It might be that the assets that would be the best ones to gift are also the assets that have the lowest capital gains basis, and therefore would mean that those assets would not be eligible for a step up in basis at the time of death, and so would lose that benefit. It also could be that there might be other assets, might be things such as business interests or retirement accounts that really can't be gifted yet. So it just might not be the right timing for those gifts. One another type of planning that we can do is using trusts. Here we're doing, it's not a gift during life, but it's a gift at death. And if federally it's known as a credit shelter trust, I like to call this credit shelter trust, when we're using it for Washington purposes, a Washington exempt trust. The Washington exempt trust or credit shelter trust gives us the ability to utilize both of the spouse's Washington exemptions. So with this tool, we can protect up to nearly $4.4 million from Washington estate tax. And the way it works is fairly straightforward. We direct in the documents, the estate planning documents, a portion of the deceased spouse's estate up to $2.193 million into a trust for the benefit of the surviving spouse. And that would allow then those assets to continue to be used and available for the spouse. But at the spouse's death, they would pass estate tax free to the beneficiaries. Any appreciation that happens on those assets during the survivor's life would likewise pass tax free. So the growth on those assets will also go tax free. And you can imagine if you put put nearly $2.2 million into that trust, and the surviving spouse was able to be with us for another 10 years or 15 years, there could be significant appreciation inside that trust. It could go from 2.2 to 3.3, 4.4, something like this. And all of that growth would be outside of the tax system also. One other type of trust that we do think is a one to consider is a life insurance trust. So these are often known as irrevocable life insurance trusts, or ILITs. The idea here is that life insurance really is not providing a benefit until death, but yet if you own it in your own name, it will be included in your estate, and therefore that estate tax, it will be estate taxable. A portion of your premium dollar, therefore, is going towards paying estate tax. So the insurance trust is designed to own that policy outside of your estate so that it could bypass that Washington state estate tax system and be able to go down to your heirs without the need for taxation on it. This can be used to help address that issue where we're not quite ready to start doing the big gifts. In fact, this would be a good tool to use for the initial gifting of kind of a starter gifting tool, if you will. You can gift small amounts into an ILIT. Those amounts could be used to pay a premium on a policy that would pay out at the death of either the grantor, or if they're married, either one of the spouses or both the spouses, whatever it is, to provide liquidity then to pay that tax, so that the assets don't have to be sold immediately after death to pay a death that estate tax at 9-month mark. And so this is a tool that we look at and think will be continuing to make more of a comeback here in the next few years, as more and more people find that that smaller exemption, the Washington exemption, just isn't cutting it anymore with their estates. A few other strategies that we can use to address the tax issue. One thing that can be done is you can use what's often referred to as a Q-tip trust. This is really a trust for the spouse that could either be included in the surviving spouse's estate or excluded from the surviving spouse's estate. This provides a flexible, easy way to do planning. It's one of the strategies that we use to create that Washington exempt trust. And it's a very common one. One of the benefits of that one is that it allows a split election. So we could have a different election for federal purposes and a different election for state of Washington purposes. The reason to do this is that it would give us an opportunity to be able to get a second step up in basis on any capital assets that are put into the trust. A second step up in basis is really the holy grail when it comes to capital gains tax planning. It gives you two bites of the apple to get the step up and eliminate capital gains. One point I do like to make to people that may not realize is that if your spouse is not a U.S. citizen, Washington state, which shouldn't really care about citizenship, but does, because we incorporated the federal law when we created our estate tax system, will tax those gifts that you make to your spouse. We don't have the unlimited marital deduction available for those gifts to the spouse. So we need to use a different tool to make sure that there is no taxation at the first step, And that tool is known as a qualified domestic trust. So in addition to the Washington Exempt Trust planning to use the exemption, if that's not going to be sufficient to cover all of the deceased spouse's estate, the QDOT is an option that should be included in those plans. One other strategy that I do feel like I have to mention is that Washington estate tax is just a Washington estate tax. Not every state has estate taxes. There are many states that don't have estate taxes, that didn't have the same type of response to the 2001 Bush Tax Act that the state of Washington had. So you could move. Be careful where you move, because if you do move to a state that has other types of taxes or higher costs of living, or the like, you may actually be in a worse tax situation than the Washington estate tax. I do like to sometimes say that this is really the method that Jeff Bezos used recently when he relocated to Florida. But that was primarily to get away from the Washington capital gains tax, I believe, not the Washington estate tax. So we've talked a little bit about capital gains. Let's look a little deeper at that. How does capital gains relate to estate tax planning? First of all, we've mentioned the step up in basis. This is actually what's known as the code section 1014 fair market value basis adjustment at the time of death. It is usually a step up in basis, but it could actually be a step down in basis also. But it's permitted for property, all property of a deceased spouse. That would include, or of a deceased person, and if they're married, it would include not only the separate property of the deceased spouse, but also 100% of the community property. And so it can be very valuable for folks. Those capital gain rates need to be taken into consideration and compared then to what the Washington estate tax rates and exposure is. So we see that the federal capital gain rates can, we do have a 0 and a 15% and a 20% bracket. For some folks, they might also be facing the Washington state capital gains rate of 7%. That was initiated back in 2022 with a $250,000 threshold. That threshold is indexed, so we do have some indexing that works here in Washington, and is in the, I think, around 265 this year. So holding appreciated assets, what I would call low basis assets, so the basis, the value that's used to calculate the capital gain is much lower than what its fair market value is. So holding those appreciated assets until death can be a real benefit for the heirs. And I'd just like to mention, we did mention one of the difficult assets to gift was going to be the retirement accounts. Those are locked in to your to a disbursement schedule. I can't access them really until 73, but they're also in a very income tax advantaged instrument in those retirement accounts. So taking those dollars out, paying the income tax on it, and then gifting it is not a real appealing strategy. We do have some changes that happened for the retirement accounts that we're looking at. In 2020, we had the Secure Act come into place, and that changed the distribution pattern for beneficiaries to 10 years. I do like to point out that with retirement accounts, they're actually the worst asset to inherit, since when you get those dollars, there might be estate taxes that are due on that inheritance. Plus, as the money comes out of the retirement account, you're going to be paying income tax on it. So from an inheritance standpoint, it's a really bad asset to inherit. On the other hand, a Roth retirement account is a very good asset to inherit, since there's no income tax issue on that. And at least you could have some deferral over the, or keep it out of, continue to get that tax-free growth during the 10-year period as it's being paid back out to you as a beneficiary. If you do have charitable bequests that you're considering, traditional IRAs and retirement accounts are great ways to make those gifts, since you'd be eligible for a charitable deduction when that gift is made, or the estate would, for estate tax purposes, and the charity would get the full value of that gift, since they would not need to pay income taxes on it. Of course, it doesn't make a heck of a lot of sense to direct a Roth retirement account to a charity. Charitable remainder trusts are a unique method that we've seen to stretch out that withdrawal period over a longer period of time than the statutory 10-year period, and it's a bit more than I can talk about here in this meeting. Okay, so what kind of advantages do we have with the charitable giving? So yeah, we spoke a little bit about the tax availability there, but it does reduce your estate tax. Donor advised funds are really something that's been growing and something to look into. Your financial advisor may have a donor advised fund setup that you can use. There's also local community foundations that can set those up. The Seattle Foundation here in Seattle was one of the leaders many years ago, and they still do them. Charitable remainder trust is a way to make a gift into a trust today, reduce the size of your estate today, allow an asset to be sold without capital gains tax hit immediately. Those assets can be reinvested, and then a stream of income can come back to you. So it can be a very interesting tool to use. Couple of examples I wanted to run through. Here's the Johnsons. Total estate, $5 million, a family home, retirement accounts, investments. They want to minimize the estate taxes for their children. They could gift, they could use lifetime exemptions, but really using that credit shelter trust to utilize both exemptions is going to be a primary thing they're going to look at. Since they have young children, they might consider, they may have life insurance already, and if they do, they should consider putting that in an ILET to keep that outside of the tax system. If the kids are too young to gift to, they may not be quite time to start that gifting, but they consider that if they're as the kids get older. So before planning, they would have potentially had a $361,000 Washington estate tax. Through use of these different tools, they're going to be able to bring that tax down to zero. Planning for non-citizen spouses. Here's another example. This one we're seeing the Lee family. So the problem is, if we didn't have a QDOT in place there, as Mr. Lee leaves part of his estate to his wife, there would be a Washington state estate tax on that. And thank you everybody for coming today, and go ahead and send in your questions. If we didn't get to them, we'll try to get answers out to you. Bye now.